Right, everyone, we might get started then. As I said before, my name's Matt Byrne. I'm the founder and director of Day One Advisory. We're an accounting and business advisory practice in Melbourne. We service clients nationally, and I'm here today to chat to you about tax planning. Now, it might seem a little bit early in the year to be talking about tax planning, but as you'll see in a bit when we talk about some strategies, some of these will have an impact on your cash flow. And so for me, whenever we're talking about cash flow, it's never too early to start getting an understanding of that so that you can better plan and, of course, manage your cash in your business. So today we're going to talk about what tax planning is and why we think it's essential for all businesses. We're going to look at some common strategies that will help you minimize the tax you need to pay in this year, but also have in consideration to future years. And then we're going to talk about how to calculate and budget for your tax liabilities, which in my mind is as equally important as the strategy side of things. So what is tax planning? Well, tax planning is the process of forecasting the accounting profit or loss and then working out your estimated tax adjustments to get back to your taxable income for the year. You can then look at what strategies need to be implemented in order to minimize that tax liability, not just in the current year, but over the lifetime of the business. And finally, the last step of tax planning is to estimate those tax liabilities. It's also then to look at the expected due dates for lodgement and payment. And then it's about budgeting for those tax liabilities so that when they fall due, the cash is available and you don't come across any issues with the ATO, payment arrangements, and those sorts of things. So tax planning is essential for a couple of reasons. The first is that some of the strategies we're going to talk about today have a time sensitive. So they need to be done this side of 30 June. Now, in order to do that, you need to be aware of what those items are and what action items need to be done. So tax planning is a great way to set out those action items and make sure things get done by the due date that they need to be done. And the second part that's essential is what we spoke about just now is the awareness around your tax liabilities so that ultimately you can have better control over your cash flow, because tax is an expense like anything else in the business. And for a lot of people, it's a very material cost. So you need to budget for it. You need to factor it into your cash flow. And tax planning is a perfect time to do those forecasts and understand what your liabilities are so that then you can better control your cash. So these are the tax planning strategies we're going to talk about today. They're not, it's not an exhaustive list, but it's sort of the key ones to consider leading up to 30 June. Tax planning is going to be very circumstantial. It's going to change depending on what business structure you have. It's going to change about your family group and any other income or expenses. And also it's going to be dependent on how much money you actually make and what sort of tax we're talking about. So these are the common strategies, but how they apply to you in your group is going to be very different to, to say how they apply to me. So what it's important to do is to think about these strategies in the context of your business. And if you need advice on, tax planning can be complicated. So seek advice on what strategies are relevant to you and what impact that's going to have both now and into the future of your business. So the first one I want to talk about, and I think this is a fairly underrated option, is the timing of income and expenses. So when we talk about the timing of things, we're talking about whether they fall this side of 30 June or after 30 June. The consequence of that being that if they're this side of 30 June, they're within the current financial year, so 2022. And if they're on the other side of 30 June, then we're talking about the 2023 financial year. The difference there being that they change the taxable income in the current year and they can either reduce or increase it. And the difference being that there's effectively 12 months timing difference on the subsequent tax liabilities that arise. So there's a couple of ones that we want to talk about in terms of timing. So deferring income is a way to move that assessable income into a future year and has the result of decreasing your current year taxable income. Now, I want to say off the bat, tax planning is a perfectly legal thing for you to do. There's no issues with tax planning. However, you have to be really careful about doing things purely from a tax perspective. So if you go and do something that has no real commercial rationale and it's just a tax issue, so in that, for deferring income, for example, it might be just choosing not to issue an invoice, potentially that can be a bit risky. So whenever we're talking about things like deferring income, it needs to be commercial in your business. Deferring income, the considerations here are, if you've got, jobs in June, potentially deferring the completion of those jobs or just working on the timing might result in that income being derived in the next financial year and therefore not being included in the current year taxable income. So if it's possible, particularly where you have, maybe you have a very significant job, you might want to complete that next year and invoice it next year, resulting in the income being pushed out for 12 months and the tax liability on that income also being pushed out by 12 months. The other one is bringing forward expenses, and that includes any capital expenditure. Now, when we talk about bringing forward expenses, we're talking about things that you are already going to spend money on in July or August or early in the next year. And so what you're going to do is you might say, well, rather than spend that money in July, if cash flow permits, I'll spend it in June, and that brings the expense into the current year and ultimately might avail you of a deduction this financial year, reducing your tax liability. The trap that people can get into in this is they say, well, I've got to go and find a bunch of expenses before 30 June to reduce my tax. And often they can go out and spend money on things that they don't need, that don't add value to the business, and they're doing it purely for a tax deduction. And sometimes it can actually be cheaper to just pay the tax. So I'll give you an example of that. Let's say Day One Advisories had a great year, and we've got a lot of tax to pay. I could go out and say, right, I need to reduce my tax liability. What can I spend my money on? I'm going to go and buy a car. Now, I don't need a new car, a perfectly fine car outside. But if I went and did it just from a tax perspective, and let's say I spent, $50,000 on a car, that $50,000, I might end up spending, that $50,000 might be deductible to me, and I'll get a tax deduction for that, which reduces my tax liability by, let's say, $15,000. The issue there is that after taking the 15 grand tax saving off the 50, I've still got $35,000 worth of, cost for an asset that I don't really need and I only did from a tax perspective. Whereas if I didn't spend the 50 and I didn't get the tax deduction, then I would have paid the $15,000 in tax to the government. Now, it might seem a bit counterintuitive, but in that instance, it's actually cheaper to pay the 15 grand worth of tax than it is to buy a car that's cost me $35,000 after the tax deduction. So when we're talking about bringing forward expenses, don't fall into the trap of having to go and find expenses. Tax isn't necessarily a bad thing. It means you're making money, and that's great. So as long as you're planning for it, then your business is equipped to pay that liability and grow. And ultimately, if you can continue to increase those tax liabilities, then it means hopefully your business is growing and you're making more money. So don't be afraid to pay tax, but if you've got expenses that you're already going to be spending money on, they're already factored into your cash flow, then bringing those forward might mean that you reduce your current year liabilities. The other thing to consider on the timing is just the small business prepayment concessions. Now, if you're a larger business and you prepay expenses for, say, 12 months from now, then you need to take that deduction over that 12 months. Whereas a small business will get a concession for prepayments where you could deduct that amount up front. So again, it's just the timing. You could bring forward that expense by prepaying some of your costs, and that might mean that that's deductible in this year. Now, Accelerated depreciation is great. Everybody, you'll hear a lot about depreciation. Once the TV ads start rolling through, all of the car yards will start telling you that if you buy a car before 30 June, you can claim the whole lot. And some of the other big retailers will jump on board that as well. Now, the one that we're talking about at the moment in terms of concessions is the temporary full expensing concession. So that's been extended out to 30 June 2023. So we've got plenty of time to still use that. And what that temporary full expensing concession does is that it says if you buy an asset and you have used it and installed ready for use before 30 June, then you may be able to deduct that full value of that asset in this current financial year. So let's say you go and spend $100,000 on a bit of equipment. That $100,000 might be deductible to you in this year. So the point is it's incentivizing businesses to go out and to invest in assets. The thing to consider about any accelerated depreciation measure is, in that example, $100,000, to some people will be a very large deduction if you went to spend that money on equipment. You've got to consider whether that's actually the best option. And the reason I say that is, let's say in the current financial year, you have a relatively low taxable income and your average tax rate on that income's, let's say it's 20%. If in the next year, you're expecting to have a pretty bumper year and your average tax rate in that year might be 35%, then it may be better to take that deduction against next year's income and that deduction be worth 35 cents in the dollar, rather than putting it into this year where it might only be worth 20 cents in the dollar. So something to think about with timing is, while usually the position is if you bring forward those sorts of costs, it's better for you. If you're looking at tax planning holistically over the lifetime of the business, you're actually looking for the overall lowest average tax rate on your income. And because we have a marginal tax rate system in Australia, particularly for individuals, it could actually be advantageous to sometimes delay the deduction until next year. So just have a think about what impact that has on your business by bringing forward, a significant deduction under these depreciation rules. The last thing I want to talk about here is the interaction between the depreciation concessions and some other things. So the first one is the loss carryback rules. Now, this is a temporary measure. It applies specifically to companies. It doesn't apply to sole traders or trusts, so only companies. What it does is it basically says if you make a loss in the current year, you can take that loss and apply it to previous year's profits, resulting in a refund of the tax that you paid in those prior years. So if you go and buy a bit of equipment and it's worth $100,000 and it causes you to be in a loss in the current year, you might want to think about applying the loss carryback rules to get an offset of tax you've previously paid. There's plenty of things to consider in that, and there's plenty of other requirements. So I would strongly encourage you to get advice if you were looking at those loss carryback rules. Now, the other thing to consider, which a lot of people don't think about, is the car limit. So if you buy a car, and a car doesn't include a truck or a ute or a van. It's just a car that's primarily designed to carry passengers. There is a limit on the deduction you can claim, and for the 2022 year, that's about $60,000. So what that means is if I went and spent $100,000 on a car, I can only ever claim $60,000 of that. So while I've gone and spent the 100 grand, the accelerated depreciation measures will apply, but I'll be limited to 60,000. So that's something that people forget a bit. What it means practically is maybe sometimes it's actually beneficial to, if you're buying a personal car, rather than buy it in the business, it might be better to buy it in your personal name. But again, seek advice on that and see how it applies to your situation. Next, I want to talk about super contributions. So super contributions are come in two parts. One is for your employees and one is for you personally. Any super contributions are deductible when they're paid, but there's an extra step to that. They also need to have been received by your employees or be recognised in your employee's super fund to be deductible. So what that means is if you make contributions prior to 30 June and they're recognised in your employee's fund before 30 June, then they should be deductible in this financial year. So what you might think about doing is bringing forward the contributions that you'd be making for the June quarter, which ordinarily would have to be made by the 28th of July. If you made those contributions before 30 June, they might be deductible to you in this year. The watch out is that clearing houses take time to process super payments, as do super funds. Now, each super clearing house will generally give you a cut-off date sometime around the middle of June, and they say if you make contributions by this date, we guarantee that they'll be in the fund by 30 June. So it's important to keep an eye out on that and make sure that if you are trying to do this and bring forward your super deductions, make sure you are keeping an eye out on how long it takes your clearinghouse to process those payments. The next one we'll talk about is personal contributions. So that's, let's say you as an employer, you as a business owner making contributions to your own fund. If your contribution is, if your total contributions for the year are, up to 27,500, then provided you've done all your necessary paperwork, those amounts could be deductible to you. So if you were to make a super contribution of 27,500, assuming you haven't paid any other super during the year, that amount should be deductible to you. You'll pay tax on it in your super fund. Super funds are taxed at 15% on that income. But let's say, for argument's sake, you pay tax at you're in the top marginal rate and you're paying 47 cents in the dollar. You can see pretty clearly that there's a differential between the tax that you would pay in your personal name versus what the super fund will pay at 15%. So that's where there's a tax saving, is that you get a deduction at 47 cents, but you're only then paying tax at 15. So the difference between those two tax rates is your tax saving. Now, in terms of those personal concessional contributions, there's a catch-up option. So if in the previous years you have not made your super contributions, potentially you can use apply that unused cap from prior years to the current year. So what that means is you might be able to increase your super contributions beyond the 27,500, ultimately resulting in higher tax deductions for you in the current year. Now, logbooks are, I think, very important. Basically, whenever you own a car in a business, there is necessarily a private use of that. Now, what the rules say is that the business is only entitled to deduct the amount that relates to the business use. And if there's a private use component, if you're a sole trader, there's just an adjustment that's made. But if you're a trust or a company, then you might have a fringe benefits tax liability. Now, most business owners, what they do is they say to avoid that fringe benefit tax liability, we're going to make a contribution to the business equal to the private use component. That's usually just done as a journal entry by your accountant, but the effect of it is that you end up with only the business use of the car being recognised in your sort of tax adjustments for the business. If you don't have a logbook, then you've got to use the statutory rate to work out that private use component. The statutory rate is broadly 20% of the purchase price of the car. Now, if you've gone and bought a $100,000 car, you can see that the private use component each year is going to be about $20,000. However, if you have a high business use and you don't really use your car much for private purposes, then keeping a logbook means you get to use the actual business use percentage. And so what that can do is it have the overall effect of reducing that private component and the contribution that you need to make, which ultimately has the impact of increasing your tax deductions in each year. So logbooks are going to be important because it gives you the opportunity to either apply the actual rate, or you can always go back to the 20% statutory method if that gets you a better outcome. In order to keep a valid logbook, it needs to be for a 12-week period. Provided you've started that logbook before the end of the financial year, that logbook can apply to the current year. You don't need to have finished that full 12-week period in the current year, just need to have started the logbook. So the other thing to keep in mind is, people often think that just because, I've got a ute or something, that I don't need a logbook, whereas the ATO in recent years have taken a stricter view on that and said that, well, actually, yes, you do, and there's going to be a private use component unless that private use component is some sort of incidental amount, and it's very low threshold. So I think irrespective of whether it's a car or a ute, what have you, it's important to keep a logbook to track the private use of the business to make sure that then that adjustment that has to be made at the end of the year isn't more than it needs to be. Now let's talk about inventory. This is only obviously relevant to those businesses that hold stock at the end of the year. But there's a few methods that you can use to value the inventory of the business. The most common is going to be cost. So if I spend $100,000 on stock during the year and I've still got 50% of that stock on hand, then the inventory is going to be valued on my balance sheet for tax. Well, it's going to be valued for tax purposes at $50,000, being 50% of the 100 that I spent. If, however, I've got, so we go back to the example before where I have a relatively low taxable income in this year and a high taxable income next year, by using one of these other methods, what might happen is you can actually effectively move deductions from current year into next year. And the way that happens is that when you say I'm going to value my stock for tax purposes at market selling value, let's say I bought 100 grand worth of stock, still got $50,000 left of it, but it retails, my markup on it is 100%. So that means that 50 grand that I've got left over that I paid actually retails for 100. By doing that, what's going to happen is instead of having a $50,000 deduction this year, I'm going to have no deduction, but I get to move that 50 into next year. And you get to move it into next year where you have a higher taxable income and a higher average tax rate. So that's pretty complicated, and I don't necessarily expect everyone to understand that straight away. But if you hold stock, I think the overarching comment is just have a think about what valuation method you should use. And most of the time it's going to be cost, but there are situations where the other methods can apply and get you a better outcome, not maybe in the current year, but it'll get you a better outcome over the next couple of years. And of course, because you change your closing stock valuation method, that means that that becomes the opening stock for next year. So like I said, it has an impact, not just this year, but it has an impact next year as well. So this is one of those examples where we're looking at tax planning, not just specifically from a current year, we're looking at as the business overall and trying to reduce the overall average tax rate. Now, business structures. Often businesses will set up their structure at the very beginning. And that structure might have been perfectly fine for that business in the beginning. But what happens is, over time, the business changes and also the law changes. So one of the relevant changes that we've had is we've been reducing every year the company tax rate for small businesses. And it's currently 25%, which is a pretty good tax rate. So previously, businesses that are operating out of a discretionary trust, for example, you might be distributing all your income to individuals. It could be worth reviewing your structure to figure out whether you need a company in there somewhere to avail yourselves of this 25% tax rate. So if you do review your structure and decide that, things have changed and actually we need to update our structure to work effectively with our existing business or the business as it is today, there are some rollovers available. Now, those rollovers basically say that whatever tax liability that would arise on changing that structure, you get to defer that. That's pretty complicated stuff. So if you're going to change the structure, make sure you get advice, because you might inadvertently trigger what potentially could be a pretty big tax cost. The other thing you could do is, rather than change the whole structure, in some instances, you can just append a bucket company. So that might work where, let's say you operate your business out of a discretionary trust. Rather than distribute the income in that year to individuals, you might choose to distribute some of it to a bucket company, and subject to satisfying we call the base rate entity rules, you could use the 25% tax rate. Now, again, there's some complications with that, and there's some consequences if the money doesn't go to that company. So anytime you're talking about business structure, get some advice. I suppose the overarching comment in relation to business structures is businesses change, and the environment and the law changes over time as well. Tax planning is a really great time to look at the business structure and make sure it's still appropriate for your business, both now and in the future, with what you're expecting to happen around. Let's say there's a potential exit, or just the ownership's going to change, or the amount of income is going to change. It's important to review that structure and make sure it's appropriate for you now and then into the future. And tax planning, like I said, it's a pretty ideal time to do that. And so when you're doing this tax planning process, just think about that, raise the question, and you might find that your structure is perfectly fine, but there could also be some really good opportunity in there for you. Now, a few other things to consider around strategy. One is your debtors. Now, when you raise an invoice, there's two sides to that transaction for accounting purposes. One is it goes to your income, and the other side goes to your accounts receivable or your debtors. Now, let's say you've got debtors in there that have gone bad and these people aren't going to pay you. Well, that's still sitting in your income. So what's important to do is to review your debtors, and if you do have some debts in there that are bad and you're not going to collect them, is to write them off formally before 30 June so that you're not paying tax on income where you're never going to receive the cash. What we've spoken about so far today is primarily business deductions, but don't forget about personal deductions as well. If you're an employee in your business, or you pay yourself a wage out of your business, then you might also be able to deduct things like home office expenses, income protection insurance. The ones I haven't put there are personal donations. If you own a car that you use for business but you own it in your personal name, then potentially there's a motor vehicle claim in there too. With home office expenses, the ATO has a sort of concessional COVID rate of 80 cents for every hour you work from home. And if you were to work from home full time, and you have done for all of 2022, that home office deduction, it can be up in the range of $2,000. So these deductions, we're talking hundreds of dollars of tax saving. So definitely worth keeping those in mind when you're doing tax planning. And we've touched on this a few times, but tax planning isn't a current year thing. You'll find a lot of accountants will, they'll sell really hard on the fact that they're saving a lot of tax right now. And that's fantastic, but that can have consequences for the next few years. And so while it's a really easy way to win new clients and bring new clients on board, you need to think about tax planning not just now, but over the lifetime of the business. So keep an eye on the future. Keep an eye on what's happening with the business. Have a think about what impact any strategies you put in place have on next year, on the year after. And just make sure that, like I said, that the goal of tax planning is to make sure that over the lifetime of the business, you're paying the lowest average tax. So you don't want to do something this year that then causes you issues down the line. So look at tax planning holistically and think about the future. Now, those were the strategies. But the next step after the strategies is then actually to calculate what the tax liabilities are going to be and budget for them. So the steps involved, and we've sort of been through this a little bit already, but broadly the steps involved in tax planning are to forecast the accounting profit or loss, because that's always the starting point. Once you know the accounting profit or loss for the year, you can then put through your tax adjustments. Now, tax adjustments could be little things like, non-deductible expenses such as entertainment or fines or things along those lines. A good place to find or sort of work out what your tax adjustments might be this year is to look at prior year. A lot of these things tend to carry over year on year and can be pretty consistent. The next step is then to estimate the tax impact of the strategies that you plan on implementing. So let's say, that might be buying a bit of equipment. You say, well, the tax impact of that, buying that $100,000 piece of equipment is a reduction of, is a deduction of $100,000. So it's important to factor in the tax impact of the strategies. Once you know the taxable income, it's then important to identify who's actually being taxed on that income. So if you're a sole trader, that's going to be pretty straightforward because you don't have any flexibility. It's all taxed in your name. Whereas if you're in a trust structure, for example, you might need to make trust distributions before the end of the year and determine who that money is going to be distributed to. So it's important to identify who's actually going to be taxed on the income, because everyone's different tax rates are going to impact the tax liability overall. Once you know who's going to be taxed on the income, it's then important to include any other income or expenses that those people have or those entities have. That could be things like investment income or interest income on your bank account. And the expenses are going to be things like we spoke about before around home office deductions or super contributions or donations, etc. Once you've then figured out what the taxable income of those individuals or the entities are, you can apply the tax rates to work out what their tax liability is going to be. Now, if you've got a company is going to be pretty straightforward. You get a flat tax rate of, let's say, 25%. So it's pretty easy to work out what your tax is going to be for that company. If you have individuals that are being taxed on the income, what you can do is use the ATO calculator or jump into like paycalculator.com.au or something along those lines. If you punch in the income for the year, it'll then tell you what the tax liability is, what Medicare levy cost is, whether there's a HEX repayment, all those sorts of things, and it'll also factor in some of the offsets. So that's a great way to figure out what the tax liability is, especially because we have a marginal tax rate system in Australia. The final piece is then to deduct any tax that's already been paid during the year. So that might be PAYG instalments, it might be withholding from wages, or it could just be some withholding tax or other tax offsets that you might get. Once you've got to that point, you'll then know what the total tax liability across your group is for the year. The next step after that is then to work out, well, when are those tax liabilities actually going to fall due? So for businesses that are lodging under a tax agent, generally that's going to be somewhere between March and June of the following year. So for this year, for example, for the 2022 financial year, most of my clients will be lodging either 31 March or 15th of May. So if we're doing tax planning now, we're potentially getting at least 12 months notice ahead of those tax liabilities being due. So there's heaps of time to plan. I'd suggest you check with your accountant when your tax returns are due. Or at least they should be telling you as part of the tax planning process anyway, but if you're doing it yourself, make sure you ask the question just so you know when those tax liabilities are upcoming. Now, this is one that catches people out a bit and can often be a bit of a problem, particularly where a business is growing or you're new to business. Now, once you lodge a tax return as a business and you've got a tax liability, it's likely that the next quarter, the ATO are going to start asking for PAYG instalments. And PAYG installments are just a prepayment of that year's tax. Now, let's say your first year in business was the 2021 financial year. We're doing tax planning for 2022 now, and in about May, you're going to lodge a 2021 return. Let's say 2022, you've had a bumper year, and you're going to have $100,000 payable in about May 2023. Because you've lodged a 2021 return and assuming there was tax payable, from about September, the ATO is probably going to start asking for PAYG installments. So what that means is not only are you going to be budgeting for the 2022 financial year tax liability, you're also going to have installments that relate to the 2023 year. So the issue there is that you can end up bundling up a bunch of tax payments, all sort of roll up in the same period, and all of a sudden you're paying a lot of money to the ATO. So while it's really important to forecast, the final tax liability once you lodge your tax return, it's also really important to understand what upcoming PAYG installments are, so that you're budgeting for your tax liabilities, and you don't, fall behind or get a surprise bill. Now, the last thing I want to say on this today is often business owners think that by delaying the completion of their tax return, they get to delay the payment of their tax. I think it's a better option to complete your tax return as soon as you can. Completing your tax return in of itself doesn't bring forward your tax payment date. It's actually the lodgement of that tax return. And so what happens a lot of the time is you can complete your tax return and then just withhold the lodgement. So the benefit there is that by completing your tax return, you get the final number on your tax liability, and you get it early, so you have time to budget, and you can withhold the lodgement so that you can defer the payment date till as late as possible. Now, in relation to the completion of your tax return, the reason that it can be detrimental to defer it is, while tax planning can be pretty accurate, it is ultimately a forecast. And let's say between tax planning at the end of the financial year, your business has gone gangbusters and you've added an extra $1 million of income. What that means is that while you might have forecasted a tax liability of, say, $100,000, once you lodge your tax return, because of that extra income, let's just say you've got a $200,000 liability instead. Now, if you hold off on completing your return until close to the lodgement due date or payment due date, what's going to happen is you've got a surprise $100,000 bill pop up. So your tax bill is $100 grand more than you'd forecast. And so the issue there is that then all of a sudden you're scrambling to find that extra $100,000 because you were budgeting for only 100, not 200. So like I said, I think completing your tax return sooner rather than later is better, but just talk to your accountant about potentially withholding the lodgement so that you can then defer the payment due date. So that brings us to the end of today's webinar. Thanks for coming. Obviously, it's great to have you, and I hope you got some benefit from it. I hope that there was some strategies in there that are going to be relevant for you and some considerations before the end of the year. If you've got any questions or you need any help, by all means reach out to us. We do tax planning across the board for our clients, and yeah, we think it's vitally important. As an accountant, I also really enjoy this time of the year and tax planning. I like sitting down with my clients. I like looking at the future and planning with them. So I hope you got some benefit. I hope that you can go away and sort of got a good view of tax planning. But like I said, if you've got any questions, by all means reach out, and we hope to see you again on the next webinar. Thanks very much.